$115.94. That is the price of silver flashing across trading desks around the world on this day, January 26, 2026, and that number represents something that the vast majority of market participants thought impossible just 12 months ago. 365 days, 284% gains, from $30 to $116. This is not a normal bull market. This is not even an extraordinary bull market. This is one of the most explosive precious metals rallies in the history of financial markets, unfolding in real time. The psychological $100 barrier that traders said would hold for years, obliterated 3 days ago, the nominal all-time high from 1980, the Hunt brothers' peak that stood unbroken for 45 years. Now, a footnote. The $112 record set earlier this week, already history, surpassed multiple times as the rally continues its parabolic ascent. Every silver forum is celebrating. Every precious metals commentator is projecting higher targets. $200, $300. Some whisper about the inflation-adjusted 1980 high, which would put silver near $200 in today's money. The narrative is powerful and intoxicating. Industrial demand is insatiable. Supply is constrained. Central banks are finally awakening to silver's strategic value, and the green energy transition guarantees endless consumption for decades to come. But I need you to hear something that most of the market is ignoring. In Hanau, Germany, at the headquarters of a company that has been refining precious metals since the year 1660, before the United States of America existed, a team of market analysts has just released a warning about a mechanism called industrial demand destruction, a warning that directly contradicts the euphoria dominating this rally. The company is Heraeus Precious Metals, and what they are saying could redefine how this market trades over the coming months. By the time you finish watching this, you will understand exactly what industrial demand destruction means, why Heraeus sees it unfolding right now, and what it could imply for silver prices. This is not financial advice. This is critical market intelligence from one of the most credible sources in the precious metals world. And it is intelligence that every silver investor needs before the next trading session begins. First, let me establish why Heraeus commands attention that other analysts simply cannot match. This is not a hedge fund manager speculating from New York. This is not a newsletter selling subscriptions. This is not a social media personality generating clicks. Heraeus is a German technology conglomerate with over 4 centuries of continuous operation. They are among the largest precious metals processors and fabricators on Earth. They refine gold, silver, platinum, and palladium for central banks, major industrial manufacturers, mints, jewelry companies, and institutional investors across every continent. When metal flows from a mine to a refinery to an end user, Heraeus often touches that metal along the way. They see physical flows that paper traders never observe. They track industrial order books. They watch their customers' buying and selling patterns change in real time. They know when tightness is real because they are the ones struggling to source metal, and they know when demand is softening because they see orders decline. Henrik Marx is the head of trading at Heraeus Precious Metals. When his team publishes a market outlook, the most sophisticated institutional money stops and pays attention. These are not predictions based on chart patterns or sentiment surveys. These are observations rooted in what is actually happening in the physical precious metals market. And here is what Henrik Marx said in their most recent precious metals forecast. After such strong price increases, a period of reset and consolidation is likely. Silver's path may be more volatile amid industrial headwind. That phrase demands attention. Industrial headwind. From the head of trading at one of the world's most connected precious metals operations. That language is not chosen casually. It reflects what Heraeus is observing in their order flows, in their conversations with industrial customers, in the real-world data that most investors never see. Their published trading range for silver in 2026 is $43 to $62 per ounce. Consider what that means. Silver trades at $116 right now. If Heraeus is right about their lower range, we could be looking at a potential decline of more than 60%. Even their upper range of $62 implies a correction of nearly 50% from current levels. This is not a prediction of guaranteed collapse. Heraeus is presenting a probability distribution of outcomes based on their analysis. But the fact that their entire expected range sits so dramatically below current prices tells you something essential about how one of the most informed industry participants views the sustainability of this parabolic rally. The mechanism at the heart of their warning is industrial demand destruction. And understanding this concept is crucial for anyone with exposure to silver. Industrial demand destruction occurs when commodity prices rise high enough that end users can no longer afford to purchase at previous rates. Every commodity has a price threshold beyond which demand begins to decline. When that threshold is crossed, industrial consumers respond predictably. They engineer reductions in consumption. They develop substitute materials. They delay purchases. They scale back production. In extreme cases, they exit the market entirely. The bulls have argued that silver is immune to demand destruction because it is irreplaceable in critical applications. Silver is the best conductor of electricity at room temperature. Solar panels need it. Electric vehicles need it. Smartphones and computers need it. The green energy transition cannot happen without it. This argument has been correct in the past, but it fails to account for what happens at extreme price levels. Silver has crossed into territory where demand destruction is no longer theoretical. It is observable in hard data. The photovoltaic industry provides the clearest evidence. Solar panel manufacturing is the largest industrial consumer of silver. Silver paste is essential for the electrical conductivity that allows solar cells to convert sunlight into electricity. The energy transition depends on solar. Solar has depended on silver. Under the narrative that has driven this rally, record solar installations should mean record silver consumption. More panels, more silver. Simple math, but look at what the data actually shows. BloombergNEF analysts report that silver demand for solar modules installed this year will drop to approximately 194 million troy ounces. That is a 7% decline from last year. This decline is occurring despite global solar installations hitting new record highs. For the first time in years, solar silver demand is contracting, not because fewer panels are being installed, because each panel is using less silver. This is happening through two mechanisms. The first mechanism is thrifting, which means reducing silver content per unit through engineering innovation. As silver prices spiked, solar manufacturers accelerated thrifting efforts that had previously been moving at a more measured pace. A recent report from Metals Focus, which compiles data for the Silver Institute, documented this directly. Soaring metal prices have also weighed on industrial activity. In the photovoltaic sector, elevated silver prices have created significant cost pressure, prompting manufacturers to accelerate thrifting and substitution. The numbers are striking. Manufacturers using heterojunction technology used silver pastes containing over 50% silver in early 2023. By mid-2025, formulations had dropped to 15% silver. By late 2025, 10% silver products entered mass production. A researcher at Germany's Fraunhofer Institute for Solar Energy Systems stated, considering the currently ongoing enormous price level boost of silver, the pressure on the PV industry to reduce silver is currently very high. Research institutions have achieved silver loadings below 14 milligrams per watt using copper-silver hybrid pastes. That represents a 44% reduction from industry averages of 20 to 25 milligrams per watt just 2 years ago. The second mechanism is substitution, which means replacing silver with cheaper alternative materials. This represents a longer-term structural threat. Chinese solar manufacturer AICO has already begun using copper to form interconnections in its all-back contact modules. Their chief scientist stated that copper offers a compelling combination of conductivity, availability, and mechanical strength, and is highly suitable as an alternative to silver from a long-term industrial perspective. LONGi Green Energy, among the world's largest solar manufacturers, announced on January 5th that it will begin mass production of copper metallized cells in the second quarter of this this year. They explicitly framed this as a response to rising silver prices and cost pressures. The world's copper reserves exceed 980 million tons, more than 3,000 times greater than silver reserves. Copper is fundamentally more abundant and cheaper. The economic incentive to develop viable copper-based alternatives intensifies with every dollar that silver rises. Substitution will not happen overnight. Manufacturing processes must be redesigned. Efficiency and reliability must be validated through extensive testing. But the transition is now underway. Every month that silver remains above $100 accelerates this timeline. The solar industry alone represents approximately 194 million ounces of annual silver demand. If that sector reduces consumption by 15 or 20% through combined thrifting and substitution, we are talking about 29 to 39 million ounces of annual demand that disappears. At current prices, that represents more than $3 billion of silver that industrial users are choosing not to buy. But solar is just the beginning of this story. The electronics sector faces identical pressures. Silver is used in printed circuit boards, electrical switches, connectors, sensors, and semiconductor packaging. The Silver Institute reports that electronics and electrical demand reached a record high last year, growing 4% to 465.6 million ounces. At current prices, every major electronics manufacturer is scrutinizing silver consumption. Intel and TSMC, the world's dominant semiconductor fabricators, are deploying closed-loop recycling systems to reclaim silver from manufacturing waste. Cost engineers at every technology company are tasked with finding alternatives wherever silver provides marginal rather than essential advantages. In a September 2025 analysis, BloombergNEF noted that silver represents approximately 14% of total production costs for solar panels, up from 5% in 2023. At the time, silver was trading around $44 per ounce. It has since nearly tripled. Cost pressures have intensified proportionally across every silver-consuming industry. Electric vehicles consume 25 to 50 grams of silver each across battery management systems, power electronics, charging infrastructure, and electrical contacts. This is 67 to 79% more than conventional vehicles. The electrification of transportation has been a significant demand driver, but automotive manufacturers operate on razor-thin margins. The difference between profit and loss on a vehicle is measured in hundreds of dollars. Silver costs that were acceptable at $30 per ounce become material concerns at $115. The next generation of vehicle platforms will incorporate designs that minimize silver content wherever possible without compromising safety or performance. The jewelry and silverware sectors already show unmistakable demand destruction. India represents approximately 40% of global silver jewelry demand and about 2/3 of the silverware market. According to Heraeus analysis, Indian silver imports declined 14% year-on-year through October. When prices triple, consumers buy less. They choose smaller pieces. They substitute other materials. They defer purchases entirely. Heraeus summarizes the outlook bluntly. They see weaker demand for silver in several core segments and warn that high prices and recession risks could weigh on industrial consumption. Now let me explain what happens to market dynamics when industrial demand contracts. The silver market has operated in structural deficit for 5 consecutive years. Annual mine supply runs approximately 820 million ounces. Industrial demand alone consumes 550 to 600 million ounces, roughly 70% of total supply. Investment demand, jewelry, silverware, and other applications account for the remainder. If industrial demand contracts by 10%, that removes approximately 60 million ounces of annual consumption. If it contracts by 15%, that removes 90 million ounces. These are substantial volumes relative to annual deficits that have ranged from 95 to 230 million ounces. The bulls would argue that investment demand will absorb any shortfall. ETF investors have accumulated massively. Retail stackers are buying bars and coins at record rates. Central banks are adding silver to reserves. But investment demand has limits, and recent data suggests those limits may be approaching. Despite record prices, silver ETFs have experienced cumulative outflows of approximately 13 million ounces since January 1st. Total holdings have declined to around 850 million ounces. This is a warning sign. When prices rise but investment capital flows out rather than in, the rally becomes increasingly dependent on speculative momentum. The Chicago Mercantile Exchange has raised margin requirements for precious metals futures multiple times in recent weeks. They announced the second margin hike in a single week during late December. Higher margins force leverage traders to reduce positions. They increase the cost of maintaining speculative exposure. They tend to increase volatility and can trigger cascading liquidations if prices reverse. Historical precedent matters here. During the 2011 silver rally, the CME raised margin requirements 5 times in 9 days. Silver fell 30% within 2 weeks as leveraged long positions were liquidated. The price peaked near $50. It bottomed below $12 almost a decade later. Those who bought at the top and held through the decline waited years to recover. During the 1980 rally, the Hunt brothers pushed silver to $49.45. The COMEX instituted Silver Rule 7, restricting debt-financed purchases. The bubble collapsed. Silver did not approach those levels again for over 3 decades. I am not predicting that history will repeat exactly. Parabolic rallies can extend far beyond what seems rational. They can continue longer than skeptics believe possible. But the conditions that preceded prior corrections are present today. Parabolic price appreciation, margin requirement increases, ETF outflows despite record prices, industrial demand destruction visible in actual data, informed industry participants warning of a reset. These are facts, not speculation. Now, I must present the counterargument with equal rigor because the bull case remains formidable. China's export restrictions represent a structural shift in global supply. Effective January 1, 2026, silver exports require government approval. Silver has been reclassified as a strategic material. Only 44 companies are authorized to export during 2026 and 2027. This fragments the global market and reduces available supply for international buyers. Central banks are treating silver as a strategic reserve asset for the first time in decades. Russia has begun allocating capital to silver reserves. India has accumulated over 900 million ounces over the past 5 years. Official sector demand creates a floor under prices that did not exist in prior cycles. Mine production peaked around 2016 and has declined since. Approximately 70% of silver comes as a byproduct of base metal mining. New, dedicated silver mines require 5 to 7 years from discovery to production. Supply cannot respond quickly to higher prices. The physical market shows genuine tightness. COMEX inventories have declined from 150 million ounces to approximately 46 million ounces. Regional premiums have exploded. In Japan, secondary market premiums have reached 60% above spot. In Dubai, premiums run around 40%. These premiums reflect physical scarcity that paper prices do not fully capture. The gold to silver ratio remains historically elevated, above 70 to 1. The long-term average is 50 to 60 to 1. During inflationary panics, it has dropped as low as 20 to 1. If gold continues toward $5,000 per ounce and the ratio compresses, silver could appreciate significantly from current levels. Some analysts project silver reaching $75 to $80 before any significant correction, representing a final blow-off rally. Others point to the inflation-adjusted 1980 peak of approximately $200 as a potential cycle target. Both scenarios remain possible, so what should investors take from this analysis? First, recognize that both the bulls and Heraeus are describing elements of reality. The structural supply constraints are genuine. China's export controls matter. Central bank buying provides support. The long-term industrial demand story remains powerful, but the Heraeus warning is equally real. Industrial demand destruction is observable. Thrifting is accelerating. Substitution is progressing. Jewelry consumption is contracting. These are current market conditions, not hypothetical risks. Second, understand that volatility is the most probable near-term outcome. Henrik Marx stated directly, "We expect the first half of 2026 to be volatile, with clearer opportunities once the consolidation phase matures." That implies choppy, unpredictable price action before the next sustained trend clarifies. Third, evaluate position sizing with brutal honesty. If a 50% correction would devastate you financially or psychologically, your position is too large for this market. Silver earned its reputation as the devil's metal through decades of violent moves in both directions. Fourth, consider your time horizon. For those holding physical metal as a long-term store of value, short-term corrections are opportunities rather than disasters. Every major silver correction in history eventually led to higher highs. Fifth, weight your information sources appropriately. Heraeus profits from processing metal regardless of price direction. They have no financial incentive for silver to rise or fall. Their warning reflects observable physical market conditions, not positions they need to defend. Sixth, remember that consensus is typically wrong at extremes. Universal bullishness, euphoric predictions, newcomers flooding in to chase gains. These are historically warning signals rather than confirmations. The essential truth is this: the Heraeus warning about industrial demand destruction is not a bear case against silver. It is a reality check on the current price level. The industries that powered this rally, solar, electronics, automotive, jewelry, are consuming less silver because they cannot afford current prices. That is the definition of demand destruction. This does not mean silver will crash to $30. Structural factors remain supportive. But it does mean that prices above $100 may prove unsustainable if industrial demand continues contracting. The investment community would need to absorb increasingly large quantities to compensate. Any shift in investment sentiment could trigger significant correction, given how extended prices have become. Henrik Marx of Heraeus captured it precisely. The rally went too fast, too far. A reset and consolidation is likely. Silver at $115 was unimaginable 12 months ago. Silver at $50 seems equally unimaginable today, but markets deliver outcomes that seemed impossible in advance. That is their nature. The Heraeus warning deserves your attention. It originates from one of the most credible sources in the precious metals industry. It is based on observable market conditions, not speculation or positioning. It highlights risks that most participants in this rally are choosing to ignore. Be informed, be prepared, maintain humility in the face of a market that has defied expectations repeatedly over the past year, and position yourself for multiple possible outcomes rather than betting everything on continuation. One of the smartest participants in this market just told you that things may not be what they seem. Whether you heed that warning or dismiss it is your decision. But you cannot say you were not told. The story continues. Stay informed. The next several weeks will be decisive.